What's going on YouTube? In this video, we're going to go over Intel Corporation, ticker symbol INTC. Year to date, company is up 32.96%. Of course, in 1 year, 35.3%. So last week, Intel reported their Q3 earnings and beat on top and bottom lines, and analysts liked that a lot and pushed the stock up higher by about 9% last week. So we are going to jump right into the financials of Intel because I think these are something that are way more important than what the story is telling us right now, because financials will follow the story. Revenue, gross profit, net income, all trending lower. We can see net income on its own chart is now breached into negative territory. Gross margins are declining rapidly, almost cut in half in the last 8-9 years there. Net margins, same thing. We are negative net margins. Used to be 30%, all the way down to negative net margins on the company. Revenue, gross profit, year-over-year change. They're just maintaining their negative growth rate over there. Return on invested capital, they are negative. ROI, not good. PE ratio, negative. Cash to short-term debt, they're sitting at 27 billion short-term debt, 24 billion cash, and 81 billion dollars in long-term liabilities compared to 24 billion dollars in total cash. Net income to free cash flow here, we have very large negative free cash flow. Net income, obviously, we know is now breached into the negative territory there. And we can come over here. Here's our free cash flow and is just trending lower rapidly. Our capital expenditures is one of the main causes for that, and it's sitting at negative 38. Is costing them $38 billion. I hope I'm saying billions, not millions. It's $38 billion in CapEx, $28 billion in free cash flow. Share count dilution. They had been buying back shares, but as of lately, as of 2021, they stopped their buyback and are now continuing to issue out common shares and still paying out a boatload of stock-based compensation. Dividend, though, is still staying consistent, and they are growing their dividend year over year. Over to their earnings release, their 10Q. We can see 3 months end, year over year comparison. Revenues still declining. Operating expenses have declined as well by about 700 million, but they also have been doing restructuring and other charges here, which is costing them about $816 million. There's only like $136 million of restructuring charges left on the company, so we should see that go away unless they do more restructuring in the company. But if they eliminate that, that brings them down to $5.2 billion in operating expenses, which would then make this their net income a lot nicer than what it is right now. So that'll be a temporary thing, is that restructuring charge. Down here to the balance sheet, company's got plenty of cash. They got about $24 billion in cash. Last year, they had $28 billion in cash and have burnt through about $4 billion in the last 9 months. Company does have $67 billion of retained earnings. We can see that is a decline year over year, well, in the last 9 months of $3 billion. Company is using their retained earnings to continue to buy or pay out dividends. So they're using their retained earnings right here, we can see, and they're using that to buy back or pay out dividends to shareholders. They can also use these retained earnings for growing the business and many other things within the business, buying back shares if they want to, which I don't think they should do right now. I think they should focus on trying to grow the business and make it profitable again. Down here at the cash flows, so we have in the last 9 months negative free cash flow, or sorry, negative income of $985 million. We add back in depreciation, add in stock-based compensation, that restructuring charge, and amortization of intangibles. And then that gives them a positive CFO of $6.8 billion. But then we have our $19 billion that we have to subtract from our $6.8 billion of positive CFOs, which then gives us a negative free cash flow in the last 9 months of $12 billion. Last year, very similar story. Down here, net cash used for investing activities. We do have partner contributions of $1.1 billion. I think that's something to potentially keep an eye on to see and understand what that was exactly and why that's there. So something worth looking into potentially as to why there is partner contributions into this business. Issuance of long-term debt. So one of the reasons why their cash is actually maintaining only negative $4 billion versus should be negative $12 billion roughly, is because of issuing more debt. So they issued $11 billion in more debt in the last 9 months. So down here we have our segments broken down for us. We have our desktop, notebook, and other. We can kind of see how everything is comparing year over year here. And Desktop still isn't quite back to where it was. Notebooks are, other whatever that is has regained. But everything else except for Mobileye and these other smaller businesses within Intel, the big parts of Intel are not growing, but all the smaller ones are doing a much better job right now. But they're just so nominal compared to what Intel does in terms of revenue. But we can come down here. One of the biggest ones I saw was we have all other right here, which generated an income of $186 million, but cost them $2.2 billion. That is key number two to look into is figure out and see if you can't find a breakdown of what all other is to understand why or where that $2.2 billion loss came from. So there's that as something worth looking into. And also, why is there partner contributions back into the company? So two red flags for me was those two things looking through their 10Q. Over to the comps, we have four other companies to compare to. We have several red flags over here on Intel for the financials. We do have TSM on the list, and this is in a different currency. So these first two charts here are skewed to TSM's favor. We do have EPS growth rate comparables, and we can see Intel doing 43% EPS growth rate with about 4.6% revenue growth rate. So we'll have to wait and see how EPS goes with Intel, but that's what the growth rate is projected for the next 5 years. Gross margins on Intel, 38%. And again, they used to be up here by TXN about mid to low 60s. Operating margins negative, and I think AMD is a very good comparable to Intel. So I think this is something that we should compare margins to. And we can see over here, profit margin, they're in the same boat. Free cash flow, obviously Intel is burning cash like crazy. They got a massive capital expenditure, and we can see Intel AMD is doing better on cash flows. Return on invested capital, both of them are in the same boat. So overall, when you compare AMD to Intel, they're like very similar companies in terms of margins here and free cash flow, return on invested capital, really everything here in the financials side of things. Also, if you guys are interested in this valuation spreadsheet, there is a link. There will be a link in the description, access to this spreadsheet. Also, in the future, for those that are subscribed to the spreadsheet, there will be another downloadable spreadsheet in the near future that has this formula on it. There's 2,400 companies on this list here. We can see all the way down here. There's 24 different 100 different companies that have. What we're going to do is compare earnings yield to return on invested capital, and we're going to figure out some potentially unknown companies here that most of us, especially me, have not really heard of on this list. I haven't. A lot of these that I'm looking at right now, I don't think I've ever typed in those tickers before. So we might be able to find some pretty awesome opportunities within this list here. And once I get this list dialed in, I will make it available for everybody in the near future. And also there will be videos on companies you've probably never heard of in the future as well, which I think is where you're going to find the best bang for your buck for stocks instead of trying to trade Nvidia or Intel. They might be boring companies, but they're the ones that will probably do the best for you in the future. Over here at the calculator, we have peer-lunch valuation on Intel. 3 changes I made is our EPS is, I'm using forward-looking EPS of 95 cents and forward-looking PE ratio of 37.49. Also, we have an average growth rate of EPS of 50.5%. I changed that to 20%. I don't believe 50% is an acceptable average growth rate for an EPS on this company. And so this is the number that we're going to use. And I grabbed that number from Rule 72 from 3 different sources. Our average growth rate is 19%. So I actually went 1% higher than what that was. So we have then Peter's fair value of $19. We have our multiples comparison. We'll have to delete AMD and Micron from the list, which gives us a price for Intel based on comps of $16.52. Our manual PE is 21 years, which tells us we are basically fairly valued, almost undervalued based on that. Price to book, 5-year average, 2.1. Price to book today, 1.4. PEG ratio, that's real irrelevant. This is not much of a growth company. Graham's valuation gives them $39.52 per share. Dividend discount model, $40 per share. Over here at the DCF valuation, they are negative. Free cash flow gives them a negative DCF price per share. We will not be using that calculator, that number for our final valuation. Rule 72, we have an average growth rate EPS of 19% from 3 different sources. That gives us a future EPS of 5, which then gives them a fair value today of $47.92 per share. Over here at the summary, Intel currently trading for $35.57. We get a fair market value of $32.60 per share based on the calculators we just went over. Purchase price of $22.82. Analyst price target $34.88 per share. Over here on the stock chart of Intel, we have broken trend and now are in an uptrend here in this tight little channel and currently testing the bottom end of this channel. This was earnings right here, was this big tail. Earnings were very good for the company, well, in comparison to what investors had expected, and pushed this thing back within the channel last week. And hopefully, maybe this week we maintain and retest the top end of this channel. But before we do that, we have resistance here at about $38 per share, and then we have more heavy resistance here about $42 per share. So if it can break 38, I think it's got a good chance of getting up to 42, and then probably retest back down to this channel, and then maybe resume in this channel depending on how future earnings look for this company. But if we break through this channel, I think there's a chance we come back, retest, maybe down into this range of $28 per share, $30 per share, maybe even come back down and do a triple bottom retest on the company. Just depends on where investors take this company. You know, whether they think it's worth more than it is now, then it's going higher. If they don't, then it's going lower. So we'll have to wait and see exactly what they do. But based on technicals here, I think this thing might have a chance at getting back up to about 40-ish dollars per share, despite what the financials are telling us. But that is it for Intel. If you found value in this video, drop a like, subscribe, and comment, and we'll be back later with another stock analysis video.